Have you noticed Wall Street may be off the mark with its earnings estimates? Current projections predict a 9% growth for the S&P 500 this year, followed by an impressive 14.3% growth in 2026. However, seasoned strategist Adam Parker from Trivariate Research thinks these figures are overly optimistic. Parker predicts a stark reality. He believes we should expect more downward earnings revisions this year. Instead of the anticipated 9% growth, he expects earnings will rise by just 1%. For next year, the estimate is only a 4% increase. Why the caution? Companies face severe penalties for missing earnings forecasts, often the result of inflated analyst estimates. Recently, businesses like Delta and Nike saw significant drops in their share prices, 13% and 25% respectively, following earnings warnings. Parker observes that the penalty for revising earnings downward by more than 5% has been harsh recently. In fact, the average penalty has dropped into the 4th percentile of the past 25 years, indicating a tough market for missed expectations. Navigating the corporate profits landscape this year is tricky. Two main risks are contributing to this cautious outlook. The first is the inconsistent tariff policies from the Trump administration. These policies create uncertainty, complicating corporate decisions and disrupting demand. In April, the administration announced a temporary pause on reciprocal tariffs, but China remains under a heavy 145% tariff pressure. This includes a 125% reciprocal tariff and an additional 20% from Trump's actions. To complicate matters, a 10% global duty remains on all other imports, creating a maze for businesses to navigate. Despite the challenges, there's a glimmer of hope. On April 9th, China indicated readiness for renewed trade talks, contingent on respect from Washington. This could open doors for more stable trade relations. The administration continues to refine its approach. Recently, it spared key technologies like smartphones and computers from reciprocal tariffs. U.S. Customs confirmed these goods won't face Trump's 10% global tariff and the hefty 125% Chinese tariffs. As Wall Street gears up for earnings reports in the coming weeks, one thing is clear: a reassessment of expectations is necessary. Failing to do so could lead to steep penalties for many companies. In summary, it's crucial for investors to prepare for potentially disappointing earnings. Wall Street's overly ambitious estimates may not hold true. With tariffs and uncertainty looming, a careful approach is advisable. Stay informed and keep an eye on the evolving situation. For further insights, subscribe to our channel for timely updates.